thing is just lending's where everyone's blown up in the past. That seems to be like 9 out of the 10 blowups come from some sort of lending mechanism. That's the one place in crypto I'd be afraid to build.
Obviously, people should have business models so that they can build like a sustainable business and create new value.
Ethereum Foundation says it.
I know, this is super controversial at Ethereum, by the way. Like, we shouldn't have business models.
Unfortunately, in crypto, once you have a token, price becomes like the only signal of success, right? You can release a feature. If Bitcoin randomly dropped 10% that day, it's suddenly a bad feature. Hey everyone, I'm Kain Warwick and welcome to the 5th episode of Uneasy Money, because what happens on chain never stays on chain. I'm here with Luca, Netz, CEO of Pudgy Penguins, and Taylor Monahan, security at MetaMask. Hey Luca and Tay. Before we begin, here's a word from the sponsors that make the show possible.
Multi-Chain Advisors is an emerging technology growth firm that has helped create $50+ billion in enterprise value for 80+ clients over the past 4 years. They're the partner to help navigate markets. Build real traction today at multichainadv.com.
One quick thing before we start, nothing you hear on Uneasy Money is financial advice. We're just three builders talking about what's happening on chain, and we want you to always do your own research before aping in. You can find all our disclosures at unchaincrypto.com/uneasymoney. All right, guys, let's get into it. It's been a very busy week this week. I think the first thing that we're going to talk about is a little bit of Solana warfare between Solana DeFi teams, Kamino and Jupiter. So Jupiter Lend is a lending protocol within the Jupiter ecosystem. Jupiter started off as, I guess, a DEX aggregator / DEX, and has expanded vertically, horizontally, diagonally into other dimensions over the last 4 years. And I think has done a very good job at kind of dominating the Solana DeFi ecosystem. Basically, like any evolutionary niche that is available, they will go in and occupy it. As you can imagine, Kamino, that is a pure lending protocol, maybe hasn't loved that. It was cool when they were just a DEX aggregator, but now they're like a lending aggregator. And so it's created a bit of tension, I think, within the Solana ecosystem. In particular, there was this conversation about this zero contagion claim made by, which anytime anyone in DeFi tells you zero anything, run, because it's going to be some kind of psyop. So the claim, I think, was that there was zero risk of contagion within Jupiter Lend, within their pools. So the idea here being that, you have these isolated lending pools within DeFi. The design is supposed to protect someone who's in one pool from having risk of someone else doing something crazy in another pool, right? So, if Luca and I are borrowing against Pengu in one pool, and then someone else is borrowing against Sol in another pool, they don't want us to be a risk for them, right? And Jupiter was like, yeah, bro, don't even worry about it. The Pengu pools are totally isolated. And it turns out not so much. And so Kamino is like, guys, this is creating rehypothecation risk, right? People are borrowing from one pool, putting into the other, they're looping and cross-contamination risk. Interestingly, Multicoin, which it wouldn't be an Uneasy Money episode without Multicoin appearing, but this time it's Tushar, it's not Kyle. But there are two possible explanations here. Explanation one: the Jupiter team truly did not understand what isolated collateral means, which is brutal. And two, the alternative to incompetence is that the Jupiter team was actively misrepresenting a core part of their protocol in order to mislead users and attract deposits, which is worse, which is a classic Multicoin false dilemma that they love creating. This team we didn't invest in is bad in this way, or bad in this totally other, very worse way. Now, I'll say I am an investor in Kamino, and I really like the Jupiter team, so I kind of don't have a horse in this race, but yeah, what do you guys think? Option 1 or option 2, Tay? There's no option 3.
There's no option 3. I mean, I always go with incompetence because I'm actually like eternally optimistic, even as angry as I am at the world in general. Like, I'm still, I'll always go the incompetent route. But I think there's probably something else going on.
That's like, is that the cynicism? You say optimism, I say cynicism, right? Like
no, it's optimism because the alternative is that they're deliberately screwing you.
But sorry, I guess my question is, like, you've seen so many teams over the years say like, oh, this is how this thing works, right? And it does not work in that way at all. They don't understand what they built. They forked something or like copied something from like some other chain or whatever. And like, no, you don't know. We built this. Like, and then it blows up and you're like, no, you guys didn't know. So if like, obviously you got some battle scars from seeing people on the timeline being like, this is how this thing works, and it completely is wrong.
Yeah. Well, and I do get it wrong because there are people who are acting like deliberately and with intent to deceive or worse. I don't know. Luca, you go.
Yeah, I'm glad that we at least got clarity as to why they did it, versus I think maybe my initial hypothesis of like, trying to just see a competitor winning and trying to halt that growth. So I'm glad that the Kamino team, gave an explanation. I'll probably actually say it's number 2, but with a caveat. I think when you get to orgs of that size, and I know the Jupiter team is very big now, and I think when you look at all the product offerings, I think what kind of like my interpretation of what I think happened when you get to a size like that, and I experience it sometimes at Pudgy, and I think I see more of these problems today than I saw them 2 years ago when we were a lot smaller, is the delineation of information, right? Like the marketing guy, communicating that information in an X post, right, has gotten the information on how it works delineated probably through 2 or 3 different channels. And I don't expect that guy to know how it works, right? I expect that guy to actually not know how it works because, but I do expect the person, the engineer who made it to know how it works. But if the engineer who made it said, it's isolated collateral, something, and then the marketing guy on the other side of it, got an interpretation of what it was. And is that engineer like, fact checking tweets? Like Kain, you probably understand this, but like there's a point in when you're founding, and I talked to, Brian Pellegrino from Layer Zero told me this, and I was really stoked because I thought I was the only one. And I'm sure a lot, Kain, you're probably the same. Like a lot of the tweets at a certain point did go through me, but at a certain point it stopped. Like there are now tweets that don't go through me anymore. Yeah. Right.
And they're always dangerous. Every single tweet is dangerous.
Yes. And so I think that's like the issue. And then so when you have like Jupiter Lend and Jupiter Perps and Jupiter Swap, like the business is huge, right? And they have like 8 core, Jupiter Lend is now a new product. Obviously it has momentum. A lot of DeFi builders would love to have that momentum, but like it still isn't a huge part of their business, especially from a money-making perspective, right? Like it probably makes the least amount of money for them, right? And so like of all the things, the top guys are looking at over there, does that mean it's okay? No. Right. And like, obviously there's things that need to be fixed, but I do think like there's a little bit of grace to be given. Cause like this to me feels like, and just the way I like Jupiter backtracked in some of the things they did, like deleting tweets, like this just feels like a delineation of information mistake and somebody fucked up.
Mm-hmm. My question is, so when we were talking about this last week, we were in the very early throes of the drama. And the drama was basically like, Kamino, so Jupiter launched this thing and it made it really easy for people to move from one place to the other. And then Kamino was like, whoa, we don't like that. And then they blocked like the 1-click migration or whatever. And then the reaction was like, hold up, that's wrong. You're like trying to keep people to yourself. What the heck? And then after, like a couple days later, then Kamino came out and was like, okay, let us explain to you why we did this.
Yeah.
And then it was like, hold on. And then it sort of the whole story just like completely sort of fell on its head because suddenly it was like, wait, there's actually a risk here. And like, was Kamino actually doing this for other reasons? What I'm confused about is, was Kamino actually doing this for that reason from the start?
Like,
Because
no,
they didn't really make that clear.
Yeah, you come out of the gates and you say it that way, right?
Yeah.
Especially if it's a risk for the Solana ecosystem, right? Like
Right.
Kamino Solana first. That is very strange to me because usually what you should do, and I think there's some fault on Kamino's side, is if that's the case, like what I would do as a comms guy is I would be like, we are shutting down deposits here because there's a misrepresentation of how these deposits are made. They're clearly not isolated. There's clearly contagion or, potential for contagion. We hope Jupiter fixes it so we can, continue our partnership with that. Right? Like that is how you frame that. I don't how they did it was really poor.
Yeah.
So that's why I'm wondering if, and I've not gone and looked and like rebuilt the timeline because I don't care that much, but I'm wondering if they sort of like latched on to this narrative. Like once people started talking about the fact that the vaults weren't as isolated, Kamino was like,
That's the reason.
that's why we did that thing. Because that's what it feels like.
Yeah.
Due to the
It's like a post hoc rationalization of like, let's find a reason to, and I think to your point, Luca, like someone in Kamino may have been like, these things are really dangerous. Let's just block it. Like this won't be a big deal. We'll just block it and like no one will really notice and it'll be fine. And then it blew up, and then there's like a comms guy sitting on the other side that's like, why did we do this? Like, why would we block this thing? And they're like, what? It's like the timeline's melting down. So I think, there's probably, as you say, like a little bit of grace to be given on both sides. But I think the larger thing that's kind of interesting to me about this is like within the Solana ecosystem, we are now at that point of growth where like hyper growth, where you can do any, DeFi summer growth, where anyone could turn up and do anything and it all worked out fine for everyone, almost ish. That kind of early 2020 vibe then became very competitive post DeFi summer, right? The next 6 months, people were tearing themselves apart. And I think that we're seeing a little bit of that in Solana, where like it's not just money falling from the sky. You actually have to be competitive. And so now, there's some tension that's arising.
I have a question from either of you guys, if you guys could answer, just like school me on like the DeFi business. But if I had if I'm Jupe, because I'm just trying to understand like how big is Jupe lend to the Jupiter business? Just like I'm just trying to understand it a little bit. Like if I have a Jupiter pool, a Jupe lend pool is $500 million in USDC. Like what does Jupe lend make on $500 million in deposits in a year? Because they're giving 5-6%, call it 5.5%. to the user, obviously they're making some margin there. Like, are they making 1% on those deposits, 2%? Like, can I just get does either of you know, like,
I don't know for Jupiter, unfortunately. Okay. But I mean, my understanding historically on the margins for lending protocols is it's very thin. Okay. Right? Like once money goes out to, LPs, right? Because it's like peer-to-peer, right? There's a small slice that goes to the protocol outside of the peer-to-peer lending. Aave, the margins are very thin, but it's $20-30 billion, right? So, it's okay if you're making bips on that.
Well, what is thin? 10 bips, 20 bips? Just give me rough, just based on like your understanding.
Yeah, like 20 bips, 20 bips net, I think. It's not much. But it varies as well, right? And then there's like, where does the money go? Does it go to buybacks, burns? Does it go to insurance, et cetera? So like, do you count insurance as net margin, or is that like retained earnings? There, like, it's not super easy to unpack this, I think, which is why we struggle to value these.
Honestly though, like just you telling me that, like Jupiter's got way too much to lose. Right. In terms of like, they're making like on hoops and swaps, like, some of these trades will make, a couple points.
Yeah.
Like why
they're making way. One thing I'll say definitively is they're going to make like 50x more on swaps than they will be making on like 100%. Like it's a much better business. So why they keep coming up with ways to like bother other people in the Solana ecosystem, not 100% sure.
I would have stayed away from this one if I was them. If I'm being this one doesn't make too much sense.
Yeah. If if I had to guess, it's less about the direct revenue and more about like keeping
user retention, right? Like keeping it related to Jupiter. Yeah. I mean,
because historically, when you have swaps, you have meme coins, you have that whole thing is the thing that everyone's doing, you're fine. When the market shifts, though, and people aren't swapping back and forth and back and forth and back and forth all the time, you're going to lose your users unless you have something else that they want to do. And when the market shifts, a lot of times you go from like the aggressive mooning every meme coin, etc., to more like longer term passive or just more complex positions, right? Which is where the lending ultimately is going to fit in. But yeah, it's I don't think it's necessarily like the revenue driver. I think it's just sort of like another thing in the ecosystem that they expect to be able to, one, push their existing user base, two, attract new users, and then from there, try to get them to do other things.
Makes sense. The thing is just lending's where everyone's blown up in the past. That seems to be like 9 out of the 10 blowups come from some sort of lending mechanism. That's the one place in crypto I'd be afraid to build. I don't want to go there.
No leveraged Pengu loans on the horizon?
Not in-house, at least. No.
Yeah. I wanted to just call out, I thought Lily had a tweet, Lily Lou. She had a tweet where she basically was like, hey guys, hey both of you guys, I love you both. Can you please stop bickering now? Because like, in the grand scheme of things, like you two going head to head on this is like absolutely like just the most worthless thing you can do. Like pick your heads up, look around. Ethereum DeFi is so much bigger. And then everything else beyond that is so much bigger than whatever this little tip is. And I thought that was just, I don't know. It reflects like how I feel about these things. Like zoom out, guys. What are we going for? But it was also just like the timing of it was quite hysterical. And like her being like, okay, guys.
It's like the mother coming in and being like, stop fighting. Like let's just settle it down. I know. We could use one of those.
Fighting with each other.
Yeah.
Go fight the Ethereum people. What are you doing?
You know what I love though? Because if I was multi-coin funded, I would just have that energy though. I would just be ready. Because if you just know Kyle's personality, he's just ready to go at you.
100%.
So I feel like if I was multi-coin funded, I feel like it would just come with it. I'm already like a competitor and a fighter. I feel like I'd just be that much more bold to just fight.
You got a like 1,000-pound gorilla behind you that is ready to jump in if you get into a fight you can't handle. You're like, Kyle, help me out here, and then like just nukes the other guy. So yeah. All right, let's move on from Solana to Hyperliquid. So Tarun from Gauntlet and Robot Ventures, who's a good friend of mine, published a paper, I guess like yesterday or something. I didn't know we're still publishing papers, but I guess he likes that kind of thing. It's his style. Arguing that the auto deleveraging on Hyperliquid during the October 10 crash, the 10/10 liquidation event, created unnecessary liquidations. And that the algo is using like a BitMEX style 2015 era greedy heuristic, which overpenalized winning traders to backstop bad debt. Jeff responded, which is kind of unusual. He doesn't usually jump in, so that's always interesting if Jeff's on the timeline. I saw it last night. I was like, oh, Jeff's gotten involved in this. So basically saying that ADL had nothing to do with HLP or backstop liquidations and called Tarun's claims misleading. Tarun is proposing a risk-aware ADL algorithm that adjusts haircuts based on the leverage, aiming to improve fairness, solvency, and long-term exchange health. I think this whole debate about ADL, the trade-off between protecting the venue and protecting traders is something we've been talking about for a month now, right? Ever since October 10th. My kind of takeaway from this, I guess, right, is that I think models in crypto are often useless. in the nicest possible way. And that like empirical data is far more valuable. The problem is that the cost of acquiring that empirical data can be you are dead. So like you go out and do stuff and gather empirical data, but the empirical data might be that like you made a mistake in your calculations and now you're dead. And so you become a data point for future people doing things empirically because you no longer exist. And so there is this kind of like very tight sort of tension between coming up with a model and actually just like trying things. The challenge with Hyperliquid, obviously, is now they are providing empirical data to the market. Like they've got a system. It's been through multiple large deleveraging events and it worked. And so it's easy to turn up and be like inefficient, like, and take pot shots at it, and you know, propose alternatives, etc. But your alternative model that you're proposing didn't necessarily go through the same empirical conditions that the actual system did. And so I'm always a bit skeptical of like, oh, my model is the trapezoid and, you know, it does all these different cool things that yours doesn't do. And sorry, like, so yeah, I don't know. I don't know what your take on this is, guys, but like, I'm always a bit of a skeptic when someone proposes a new model that's like isolated from reality.
So I'm too stupid to, you know, really give that much feedback here, but I will give you an interesting anecdote. I actually thought I lost a lot of money on 1010, and I kind of believed this for a couple weeks. And then I did the math, and ADL. So I hedged. Wasn't delta neutral per se. I was more net long, but I did hedge with some shorts. It did close my shorts at an absolute like pico bottom that like I couldn't have closed myself. So I will just say, like, as bad as like everyone claims it was, at least for me, like one of my shorts closed like a robot couldn't have closed it better. Right? I closed the absolute bottom of the wick when it closed, which turned out to be great for me. And so like I actually recouped a little more losses than I thought. That's my only point to that. I can't speak on this, you know.
Sorry, Luca, how do you not know if you lost money or not?
So I had multiple accounts. So I have one account that's shorts and one account that longs, right? And so I was looking at the P&L. I thought I had lost like way more than I had.
Oh, yeah.
And then I was like, oh, the ADL, like there's $1 million on this short I could have made. And then I looked at it and I was like, wait, it actually closed me at the closing price. I just looked at the P&L and I thought I had made what I made. But the actual closing price of the short was quite literally the pico bottom of the wick. Like I probably had 10% more downside, which like, you know, it's basically the bottom.
Yeah.
Interesting. Okay. Yeah, you're right.
Yeah, it's break it to you, but like perp traders are not the best at keeping track of their profit and loss. You may be shocked to hear this, but like also it's not super easy, right? Like trading on Hyperliquid,
it's
not super easy to keep track of your P&L. So
yeah, no, I know, because there's like a few these individual DPRK guys who like to trade on Hyperliquid, and so we have to track them. And in part, when they trade, we have to track their P&L. And let me just say, if you think it's hard for you to do it with your own wallets, it's so much worse when you're like trying to like trace and backtrace and connect these other people's.
Are the DRPK guys good traders, or they have like profitable P&Ls?
So they are. Overall, they did pretty good. I'd say like in the last 3 months, like because they do a bunch of things. They switch in and out of stables and from ETH to Bitcoin. So like even if they don't necessarily go full Bitcoin, they'll go to like wrapped Bitcoin. One guy decided that he was gonna like do some wild stuff on Hyperliquid in like August, and I'll just say that it was like for a while there it was like, oh, he's just like us, because like he would short ETH, and then ETH would like just moon, and then he's like, oh, that was a terrible idea, and then so we would long ETH, and then Ether crashed out.
They knew this guy in the synthetics trading competition.
I know, right?
DPRK, the North Korean trading challenge.
Yeah.
So yeah, they definitely do better with like the longer term plays, I would say. They did the only money they recouped on their Hyperliquid was on 1010 though.
Interesting.
They did get auto deleveraged, which made their sort of like, because they were still down overall, but like they were up. They made like $1 million on 1010 with their positions. If they hadn't been
how much
auto,
P&L, like how much margin are these guys slinging around, right? Like our friend Wyatt, that guy, like is like how much cash have these guys got squirreled away that their handlers are not aware of?
So right now we're tracing from this year. It's like they've got, that hasn't been cashed out. They've got maybe 200 mil just like sitting around on Bitcoin and ETH. That's like ready to be laundered. What they'll do is they'll take like 1 million to 5 million chunks and then go.
But sorry. So just for context, right? There's a guy who pretended to be Wyatt. Wyatt and Nick, right? From Castle Island Ventures, right? And I had a whole thread where like I was trolling him, and I was like trying to get him to. I can't even remember the threads, but we'll find it.
We'll find it. It's hysterical.
But
basically, Kain, without realizing it, completely trolled Lazarus, guys. Like just completely trolled him, and it was like the funniest thing I've ever seen in my entire life.
So the first thing was that that the guy was like pretending to be Wyatt, and I was like, oh no, pretending to be Nick, but his handle was still Wyatt, and so I was like, oh, isn't it sad that Wyatt has died? And I had this whole thing of like, anyway, I'll find the thread. We'll post it. It was like a year ago. So back to Hyperliquid. I think the conclusion here is like people are trying different things. Hyperliquid is pretty resilient to 3-4 sigma events like 1010, and it's easy to like take pot shots with some model and make a claim that and Tarun loves models. Let's be honest, right? I'm skeptic on this one.
Yeah. And okay, I will say this though. I think that Jeff's response, like his tweet opens with those who can't do, or those who can do, those who can't FUD. Like, oh, stop. Like
But you know what? I'm here for that because there was a period of time where Jeff was like a little too aloof, in my opinion, right? Like I'm here. If you're a founder and you're not willing to like get down in the mud with us and on the timeline, then like I'm bearish on that. I'm here for the Jeff arc where he's like fighting people on the timeline.
And Tay, I will say to that point, I used to feel exactly the same way with you. As I spend more time here, I get a little more jaded, and I will tell you that like there's too much bitching and and not enough like people stepping up and problem solving. And so like I actually am more, I feel you 100%, but I'm leaning more towards that energy as I get older and working in crypto, because it's too many times, too many people feel really bold to say like really insane things and then like not even be willing to like go. So like I do feel I probably take the other side of that. And like to today, I'm probably, not the guy that's antagonizing and picking fights, but I will say some of these people on the timeline just need a little rude, little passive aggressive messaging. It might do them some good.
And I don't disagree. And Jeff and the whole Hyperliquid team have proven that they do. Like that is 100% their focus, and they'll do things that are not necessarily like quote unquote like how you should do them or whatever according to traditional crypto tradition or whatever.
Our long-standing hundreds of years of tradition that we've accumulated.
So like we're just gonna actually do things. Wild. Okay. However, I don't know. Maybe it's just me personally. Like I think that Hyperliquid would be better if they continued to evolve their models. I'm not saying that they should just drop everything and do what Tarun says. Absolutely not. Like they know their protocol and their sort of priorities and their risk tolerance more than anyone else. But I think that there's probably something in Tarun's research that could benefit them. And like the way that I always think about this is like, you want to take that information in and like carry it with you with all the other things and then continue to build. Like a lot of times, especially on Twitter, it's people are like, no, I don't understand your protocol at all. I've never built anything in my entire life. I'm going to tell you exactly what you should do, and I'm going to get very upset when you don't do it. That's
yeah.
like, you should.
Like the highly opinionated retards problem is like very, very frustrating on Twitter, where it's like, let me tell you, you don't know how it works. So I think like fundamentally though, right? Like talking about zooming out, the thing that I love about crypto and the thing that I think is the most valuable part of crypto is the fact that Tarun can publish this paper and there will be some enterprising young artist who's like, this is the solution and I'm going to go and build it. And they can go and build it in a vacuum and then release it in 6 months' time and be like, hey, I've got a new perp engine that does it in this different way, right? And like anyone can try it. Anyone can do, like, this is so different to TradFi and even like the fintech ecosystem where you cannot just build a new exchange permissionlessly and launch it as like a 16-year-old engineer, right? And here anyone can. Someone can turn up and say, well, we've got a different model and the model works this way. And you know, this is why I love this space, because it would be theoretical otherwise. But it actually, like, this will become not just a theoretical exercise. Like someone will actually implement this and tweak their model, and we will get to see, do they die? And it'll be really fun.
Do they die? Yeah, true boss.
We'll find out. So speaking of tweaking designs, so the Lighter's 0% fees have come under scrutiny. I feel like this is the third or fourth time that they've come under scrutiny. The first wave of scrutiny was like, 0% fees doesn't make sense. And then there were a lot of people that were like, no, it makes complete sense. Like fees are a race to the bottom, and therefore all fees will go to zero, which also is a bit insane, right? But interestingly, there's a Hyperliquid community account or affiliated account that's saying that Lighter's 0% fee tier is actually more expensive all in, right? Like the cost of trading on Lighter at zero fees is more expensive because the latency is 200 to 300 milliseconds. So basically the article, makes the argument that like if something's free, you're the product, which is a bit of a paraphrasing of a Web 2 maxim, right? Like if you don't know where the kind of money is coming from, then it's probably coming from you. And so this idea that like slow execution leads to adverse selection and worse fills, etc. And I think someone else compared it to like payment for order flow. So this idea that like the worst thing that you can have, and I think this is really interesting. And I don't know if this was the kind of unique insight from Lighter as to why they did this. But the theory is that the worst thing that you can have as a trading venue or as a market maker on a venue is toxic flow. So informed flow, toxic flow, there are a bunch of names for it, but like the worst thing, you don't want to be trading against Luca if Luca is trading Pengu, right? Luca has more information about Pengu, just picking a random thing, right? Or me about SNX, right? Like you don't want to be trading against the guy who has the most of that token and has like some insight, right? You don't want to be trading against Zuckerberg selling, Meta stock, right? If he's like selling blocks of Meta stock, he probably knows something, and you don't want to be trading against that guy. What you want to be trading against are a bunch of degens mashing buttons, right? Like a million monkeys on a million typewriters sort of thing. And what's interesting about this Lighter situation is only retail would trade with this much latency. And so you create this very interesting filter where it's like you're choosing zero fees, but you're getting worse fills in theory, but you also don't understand the dynamic that's actually at play, which means you are definitionally uninformed flow. Only uninformed flow would choose 0% fees. A market maker would never choose 0% fees and 300 millisecond latency. They would always choose lower latency and just pay the cost of whatever that is, right? And so it is quite interesting, I think, as a model where they have this two-tier system where they are manufacturing uninformed flow for the market makers to trade against by creating this latency. I've never read anything, and maybe this is the quiet part out loud. Maybe they'll have to kind of come out and talk about this. I've never read anything from anyone at Lighter as to like why they did this. But if they did do this, it's kind of genius, is my hot take on this, right? Like they can say to the market makers, anyone who's choosing zero fees, like you don't need to worry about them because they're just sitting there getting picked off by you guys.
Pretty genius. I'm telling you, you know what I learned? All you have to do is just tail Founders Fund. Just Founders Fund invest, you just got to tail them. Because they just are hitting out of the park. I can't really speak to this other than like, dude, you, and I say that because they recently just, you know, they probably had visibility to this. I mean, yeah, I mean, dude, like, I don't think people realize how many people make money on your just regular swap. Like once I understood how much money, you know, some people don't know, you swap a low liquidity little meme coin. Sometimes you'll lose 5% on the swap, right? And like, there's like couple guy players making money on that. And so it's just like, you guys happily marched into Photon, giving Photon 1% on buys and sells, and like Bull X and like the rest of the bunch. And, you know, at the end of the day, like you guys were paying NFT projects 5% on buys and sells. And it's like, as long as everyone's making money, they're making money. So I think that's just what it comes down to. I think this is one of those like problems that's here today, gone tomorrow, you know, and like good for Lighter for having a hook for champion, and they have a different way to making money. That's like, I could give you like 10 examples of 10 different businesses in crypto. I bet that like the end user does not know how that company's making money, but they're making a lot of money on that end user. This just seems like, again, a problem that's here today, gone tomorrow. And, you know.
Yeah. The 0% fee thing, I was kind of squinted at it. I looked at it as like more of a kind of growth hacking marketing scheme, right? Like a headline thing of like, hey, it's 0% fees, but it's worse, slightly worse, but you know, the slightly worse thing's buried. And the 0% fees is at the top of the headline, right?
Yeah. And this, by the way, this is how it's always been. Like 2017 Shapeshift, no fees.
Yeah.
No fees, right? No fees, guys. They have no fees. And they would advertise that against all the other competitors. But when you look at it, right? Okay, so then how are they making money? Oh, well, on the spread.
Yeah.
Duh.
Yeah.
So it's not that it's no fees. It's that they're making money on the spread. Okay. Now, is that better or worse than no fees? Well, you know, for most of the people that have this sort of business model, it's better in two different ways. One, because they can advertise it as no fees, which is very attractive to a huge portion of people in this world, right? But the real reason that they do it is that they actually make more money, right? Because as long as they can get the calculations right? Because there's always like this little gap, and then they have to take the spread. There is risk there, right? Like there is risk that they, you know, the user doesn't complete the swap or something else goes wrong or whatever, and then they do have to eat the loss. But so long as they do it correctly, they're going to make more money than they could with a fee, right? That's so interesting to me. Like,
I have a great take here. Anybody who's offended at the Lighter stuff, I encourage you to download Robinhood and buy an options contract on Robinhood. And if you ever see what rape looks like, that's what rape looks like. Basically, they'll denominate you at the ask when, like, if you just literally, like, don't do the fucking Gen Z dopamine fast way and, like, actually just, like, edit the number to the bid, you'll save, like, hundreds of dollars on the contract.
Really?
But that's where Robinhood makes all their money. Right? They make their money on little Gen Zer like me throwing 10 grand on an options contract. In reality, it's filling me at the they're filling on the bid, but they're auto pricing me on the ask, right? And so they're making money on they're really paying the bid, and then I filled on the ask.
And the spreads are wide on options contracts as well, right?
Unbelievably wild. And but that, at the end of the day, like, I actually think that's bullish for Lighter. Like, they can champion a 0% hook, obviously a little disingenuous. So, like, I don't like disingenuous framing, right? But, they're probably going to make more money through this mechanism, I would think, right? It's kind of like the Robinhood model. And trust me, Robinhood gets insanely, anything that's retail that's trying to hit that mass, that's how these guys make insane amounts of money.
Yeah.
But yeah, I think fundamentally, if you can say to market makers, I guarantee you that these guys, now, of course, right? Like, do people then work out, like, the toxic flow go, ooh, I wonder if there's a way that we could, like, hedge out this 300 millisecond execution risk and look like retail, and like this is a multi-round game, right? Like, round one, great, we filtered out all the toxic flow. Round two, the toxic flow comes back through the 300 millisecond latency and finds a way to exploit the market makers. But that's finance.
Yeah. I mean, I think ultimately, like, my concern here is I think obviously people should have business models so that they can build, like, a sustainable business and create new value. Like,
Ethereum Foundation says it.
I know this is super controversial at Ethereum, by the way. Like, we should have business models. But I also just, like, again, optimistically hope that the business models that we that we choose, but then also that we I guess, like, shill philosophically, are not, like, rapey ones. Like, I would prefer if
they're like bringing market efficiency, right?
Yeah,
like,
exactly.
let's make the market more open and efficient, and, like, people have to eat, but let's not make it ripping people's faces off.
Yeah. And I think if we continue to I think there's a possibility that you race to the bottom with zero fees, in the sense that everyone goes to a quote unquote zero fee model, which in reality just means that the way that people are making money is more opaque, and is more convoluted, and it's more hidden away, and that it's less clear who is losing. And ultimately that will lead to more inefficient markets, and also it'll lead to sort of like the most retail users are going to be the ones that lose the most. And ideally, crypto is supposed to correct that, right? Like, for way too long, the masters of the universe have been the ones who get all the benefit at the expense of the people. Crypto does have the ability to flip that, but it'll be interesting to see if we actually manage to do it over time, or if we'll return to, if we're just gonna take the long way around to end up in the exact same place.
Reinvent the exact same mechanism, which we tend to do, but in convoluted ways. I mean, I'm optimistic for the same reason that I said, which is that, like, anyone can come in and say, okay, there's a zero fee model. Here's the zero fee model. Here's why ours is better. Competition just begets more efficiency, right? Like, if someone has a model that's, like, ripping people's faces off, someone else is going to come in. Your margin's my opportunity, right? The Bezos quote. And someone else will come in and be like, hey, we have zero fees, but our latency is like 30 milliseconds. And therefore, the fills are better, and blah, blah, blah. And, it's very easy for someone to just literally fork Lighter, but make the latency lower, and hence crypto. So we'll continue with a discussion on Farcaster's pivot and the future of Web3 social after a message from our sponsors.
Multi-Chain Advisors is an emerging technology growth firm that has helped create over $50 billion in enterprise value for more than 80 clients, like Pith, MoonPay Commerce, and Wormhole. They've worked with some of the largest and most impactful companies in the space. They're the partner you want when you're navigating markets and trying to break out from the noise. They help navigate TGEs, go-to-market, BD, and partnerships, capital markets advisory, PR, media placements, KOL activations, and more, driving execution from launch to scale. Their results are measurable. To learn more and start building real traction today, visit multichainadv.com.
Okay, so Farcaster has shifted focus, pivoted away from Web3 social to a wallet, which is exciting for all the people building wallets on this show. So I think this is pretty interesting because Farcaster has been around for a long time. The original intention was like build a decentralized social network, right? Kind of break the back of the call it Twitter, behemoth, right? And offer an option outside of this like centralized social media thing, which is a very Ethereum goal. And I think that what it's maybe there's probably two takeaways. One is like network effects are really, really hard to break, right? Like Twitter's bad for a whole bunch of reasons, yet we all kind of squint and close two eyes and just deal with it because it's the least bad option, right? There's obviously, Blue Sky and Truth Social and a bunch of other people that have popped up to try and like kind of undermine the Twitter network effects, the X network effects, but it's really hard. Network effects are one of the most powerful forces in the universe. And so Farcaster after 4.5 years is like, actually, what about a wallet? And I think this is kind of interesting because almost it's harder if you're trying to fork an existing social network style because you're too close to them, right? Like at least Friendtech was like, what if we do this weird monetization, private group, bonding curve thing? And then obviously we know how that ended with Racer running off with everyone's money. But yeah, I guess my take from this is like this kind of felt inevitable to me that this is where it would end up. Which is a bit unfortunate. I'm a little bit surprised that they're like, we're just going to build a wallet because I'm not sure what they obviously have to build something. They've raised like hundreds of millions of dollars in funding, so they can't just shut it down and return funds. But yeah, I'm not sure that a wallet with social features is necessarily going to be the win that they think it will be.
Yeah, I mean, I probably got like two takes here. I think the first one is, kudos to them for understanding that it's not going the direction they want and having the balls to pivot, especially in a space like crypto. I think like pivoting is part of being an entrepreneur, but like pivoting your publicly traded startup that like people have spent, hundreds of hours, participating in, indexing some future reward and just dealing with that. Like obviously never easy. Dan and crew are probably some of the best builders in the space, so they'll figure it out. I'm kind of surprised they got here a little too late. Like when we did the whole abstract product, you're familiar, like we have the portal that lives through everything. Like we kind of knew it all had to be wallet first. I think if you kind of look at Phantom's playbook and you were talking to Brandon, like he's going to go and try to build some social feed and they're going to go, they're already planting the seeds for it. Like any product guy can look at Phantom and see that they are going to go in a Cash App-esque style direction and try to build, some Venmo, Cash App, PayPal, pseudo social feed, and maybe open up the grounds for that. I do believe that if you're looking at like one of the greatest, opportunities in crypto, if you believe that crypto rails are the future of the internet, an analogy I told investors for a long time was, if Python was a token and Instagram was a token, which token would be worth more? Obviously, Instagram's written on Python. I would argue that Instagram would be a more valuable token than Python. And so in that vein and in that spirit, I actually think these huge social apps in this next generation of the internet with AI agents running around, like the TAM and the upside for who cracks that code is, I very much believe, $1 trillion business, an opportunity. Obviously, those don't come around very often, so it's going to be incredibly hard to execute on. It was clear that, Farcaster didn't have that killer feature that I think would, was necessary for something like that to take place. All in all. And then my other take on it is just like, part of me is a little, I wouldn't know what the right word is, but like when I see that,
I get a little like frustrated, and I don't know if that frustration is like deviated from like envy, because like I have insane product market fit. And if I had $100 million, like why hasn't Paradigm ever reached out to me, or any of these guys who are cutting $100 million checks on things with no PMF? Why don't they reach out to the guys with serious PMF who are like, you know, growing year over year? And, you know, and so like I have, just to be candid, I have like a part of me that when I see that, I think two things. Like, good for Dan. He's going to figure it out. He's a best in class builder. They have tons of money. You know, they should have probably come to this conclusion sooner, because, you know, other people have come to that conclusion, and there's a good barometer as to where to go. It's a huge swing, so can't fault him for failing. Nobody's going to, only one or two people in the entire history of human history are probably going to be able to pull off this Web3 crypto social network. So at no fault to him. And then the other side of me is like, damn, how did Paradigm underwrite giving you guys close to $200 million? Because, you know, fuck, there's a couple guys that I know, myself included. It's like, if you give me $100 million, it'd be, you wouldn't get, it'd be insane and be the nail in the coffin. I'd place the IPO 2 years from now, guaranteed. So who knows?
I think, you know, there's a question of like, why do VCs in crypto do what they do? And sometimes it does feel somewhat inscrutable. I mean, I love the fact that you still have a chip on your shoulder. You're like, fuck those Paradigm guys. But I think that like one of the components to this, right, is they like greenfields opportunities. They like to go in, you know, we talked about this last week, like Multicoin turned up having invested in ETH, the asset, for a long time, faded ETH DeFi, and then they're like, well, this DeFi thing seems to actually be working, so let's build a bunch of projects that are going to compete with the existing ones, because they want to own 10, 20% of those things, right? Like, you couldn't come and buy ETHLand, which became, you know, you couldn't buy 10% of ETHLand / Aave, right, in DeFi summer. It was too big. So it was like, well, I'd rather just go and, you know, invent something new that's going to come and take them down. So I think there is that kind of element to it as well. I also think, like, more broadly, this is super bearish for like one of the core crypto tenets, right? You know, talking about the Ethereum Foundation, like, we're going to decentralize all the things, we're going to make them free and open and transparent, and yet we have like utterly failed to beat the largest centralized incumbent in history in this vertical, right? Meanwhile, there's other centralized networks that have actually gotten more traction while we've been trying to build the decentralized one. It, you know, like, not amazing traction, right? But like Blue Sky has their own like weird little niche, and you know, people have tried to kind of attack Twitter. Like, Blue Sky did better than Farcaster, I would argue, right? You know, by having that niche, and so this idea that like decentralized tech will win because it's open and transparent and like, maybe the time frame's not long enough here, and we just didn't get it right. But just being decentralized is clearly not enough.
Yeah, exactly. It's not. And especially when we're talking about social and like something like Twitter, right? You have to go back to, what is the actual value that decentralization actually offers? Because decentralization on its own, like, really doesn't matter at all. The value that comes from that is potentially things like, I guess you can't
resistance.
Yeah. But I mean, but what does that mean for the end user, right? It means like, oh, so Elon's not going to ban your Twitter account or censor your words, or okay.
Well, we have a decentralized social network at 4chan, so you can see how that one.
And that's the thing is, like, you know, most of the competitors that crop up are the ones that have gained traction, are the ones that, like, they either were or were potentially scared of being actually censored, right? Like, Truth Social is the one where it was like all the people that actually got kicked off Twitter during that era went to their own little network, Trump included, right? Because he was actually kicked off Twitter.
Yeah.
Okay. Now, that is valuable to those specific people. Yes. However, is it valuable to anyone else? Because social network is both giving and taking, right? Like the only reason that I would go is because I want to read those people. And the reality is, when you have such a niche, narrow, like user base of people that are pushing content there, it's very quickly it can devolve and be just a really bad echo chamber. And that's what we've seen with True Social. That's what we've seen with Blue Sky.
Yeah.
Like
it just,
and
yeah,
then
you filtered out the people. I mean, the Trump thing is interesting, right? Because like you say, well, Twitter's centralized, and it is obviously, but like it's not that centralized. Like it's not like there's like this panopticon and like they know everything that's going on. There's like trillions of bots running around. People just syndicated the Trump Truth Social posts onto Twitter. You didn't need to even go to Truth Social. You get them on Twitter and just follow some of the accounts that like screenshotted every one of his posts, right? Like Twitter didn't shut those accounts down. They're like, oh, whatever. Like we just didn't want the guy. Like we can have his messages. Like it's fine, right? And tactically, that's like a way better, end state for Twitter anyway, right? They're like, we don't want people leaving, but also we don't want that guy. So we get the best of both worlds. We get the guy's stuff and we don't have him on here.
Yeah, exactly. And by the way, that was also like a very interesting period of time for Twitter where they were, in my opinion, and I think in Twitter's opinion, and like I think Zuckerberg has come out and talked about this too, like the post-COVID social era for US companies. I think most of them are like, we didn't take censorship resistance seriously enough. And we probably should have. Like we probably should have had internal policies that really had some layers of accountability and policy so that we didn't have individuals running around banning Trump or banning whoever just because our friends that,
Yeah.
I mean, it was, some of the leaks have shown it's like literally because like the friend that was part of the admin was like DMing people that worked at Twitter.
There's a thread.
Like, just wild.
At least on the Farcaster side, I think there's like a little more an interesting little back and forth with Kobe, and I think it was Carbon around like the whole token side, because it's like interesting, kudos to Dan, because there is a lens to this that I think it at least deserves everyone's respect, which is at a certain point there, he could have launched a multi-billion-dollar token very easily, right? And could have made a lot of money from it, depending on how like he, and he did it. And he said, and in crypto is very far, there's very few builders who have the integrity to be like, I am not going to launch the token just because I had put 3.5 years of work into it, right? And that I deserve to see some upside and realize some of my gains, right, for that effort. And instead took the high integrity path and said, I'm going to go build something completely new, a wallet based off of these learnings. That's a very high integrity decision that almost nobody listening to this, I promise you, would make, right? Does that have something to do with like Dan having made it already, right? And like, obviously being early crypto and whatever, and him being like, he kind of reminds me of like Brian from Layer Zero on that point where like, Kain, you give me that vibe too. Like you made it. It seems like Infinex is like super, like you're trying to do it no matter what, obviously you guys have a token element to it, but like if it was very clear to me early on that you were just trying to build the highest integrity product possible, it's interesting because like,
but to be honest, like I if I could go back, like I might not have an Infinex token. I'm not 100% convinced that was the right call in the way that I was, say, 2 years ago when I was like, I am 100% convinced that it is better to have a token than not have a token. I think today there is, and maybe we can talk about this next week, right? Like the debate about tokenization versus not tokenizing. There have been I think even just like from a pure founder incentive perspective, right? The downside of having a token is infinite. Like even if you do make some money from launching a token, right? But whether you do or don't, the downside is infinite, right? Like the people will look at whatever the highest price that token ever got to. And like I have this conversation with Synthetics all the time, right? Synthetics, the seed round was like $8 million. It's $200 million now. If you go back to 2017, like mid 2017, it was 8 million. Now it's 200. The problem is that it went through 5 billion at one point, right? And so people go, yeah, but that's that highest price that it ever got to, which as a founder, you have very little control. People think that like, oh, I just painted that chart and like made it look like that, right? Like you can't get people to trade hundreds of millions of dollars of a thing at a $5 billion valuation through like sheer willpower, unfortunately. And the market will do what it does. And so I look at that and I go, okay, so, you know, it's 98% down or whatever from all-time high, but it's like 10, 20x up from where it started. Like crypto Twitter is like, you're a monster. And any other rational investor would be like, that's a great outcome. You got a 20x. And like, the path kind of doesn't really matter. The interesting thing is if you remove the token element of it and you didn't have a token, and it was a pure equity play, right? And someone did invest in 2021 in DeFi summer in an equity deal, and you did some secondaries and like sold 10% of the company at that $5 billion val, and someone put 200 million or whatever, you would be so much better off on the timeline. Like so much better off, right?
One guy would hate you, and his LPs would hate you.
Yeah, but yeah, like they'd be like, oh, no. But you know what? The funny thing is, I don't think that even that person would remember. Like you write checks,
sophisticated investors. This part of their
like
game.
You write checks, you forget about it, and you're like, they wouldn't even remember. They're like, in fact, they're like the incentive structure actually as a VC with LPs is to memory hole that $5 billion val you underwrote at 200. You're just like, that never happened. Like you're never mentioning that on the timeline ever. Like why would you bring it up? Right? So the incentives are completely different. Whereas like every single person who ever bought the SNX token above $10 is like, you're the worst founder in history. And I get it. Like I get it on the level of like, yeah, like that was not, was that the right price? Was it the wrong price? Like, is the price now wrong? Like, I don't know, but like my mindset has definitely shifted lately, over the last like 6 months as to whether or not tokenization, which is pretty wild. Like I was like one of the biggest advocates of tokenization. But from a pure founder perspective, if I was talking to a founder, delaying tokenization until that the thing has worked, is probably my default at this point.
Yeah, I agree. I mean, I've always agreed, but like, so I'm not saying that.
I still agree.
No, yeah. I mean, my biggest thing is that once you got a token,
give us the meta token, Tay. Put the meta token in the bag, bro. Come on.
So once you have a token or thinking about a token, even right, it shifts basically everything, and especially like priorities and product and value. And I think it makes it, especially in crypto where the data that you have to operate on is already like, sometimes it's like very weak. Sometimes it's like very biased. Sometimes like it just doesn't even exist. Once you have like that, the sort of the hype and the expectations or the token incentives itself, you can start operating on a really bad mix of like assumptions and bad data that takes you down a road that isn't, the best for anyone in terms of value creation. And it takes a lot longer for you to like, figure that out. I think that you really have to have incredibly strong like product people and leaders to be able to like keep that keep the priorities.
Well, because unfortunately in crypto, once you have a token, price becomes like the only signal of success, right? You can release a feature. If Bitcoin randomly dropped 10% that day, it's suddenly a bad feature. You work for 6 months, you release a feature, and Bitcoin drops. Therefore, it drags everything else down because your token, has high beta to Bitcoin. And now it's like, look at these idiots releasing this terrible feature that they worked on for 6 months that the market clearly says is bad. And it's like, what are you talking about? Like, but that's unfortunate. Lucas just like blowing my own brains out.
So I find it curious though, because Farcaster didn't have the token. I feel like they still, I don't know. I feel like they took a long time to reach this conclusion.
But the funny thing is, sometimes putting yourself in a bubble and having infinite money is actually really bearish, right? Having too much money is honestly, from a market outcomes perspective, my view is that like if you just picked 100 random founders and gave them $100 million, right? The outcome would be far worse than if you gave them $1 million. From a market perspective, the market would get better outcomes from those people having to actually make do with $1 million and figure things out. Like those guys would light that $100 million on fire, 95 out of the 100 of them within like 20 minutes. And then they'd be like sitting in a smoking crater being like, oh man, like that was a mistake. So
oops. Yeah, no, I agree with that. And here's the thing, you have to build something like Farcaster and really go like 100% balls to the wall, right? You do have to create a little bubble of insanity to operate within, because otherwise you're just never gonna believe in yourself, right?
Yeah, you need a reality distortion field to go and do that. And also
a really big one.
And you need to hire like expensive people. This is one of the things that's been like very interesting to me with Infinex is only in the last 6 months did we actually start to like go out to the market and say, give us your most expensive people. We want the best engineers, senior engineers, and pay them the most. Prior to that, we were focused on bringing in like crypto degens who were like much more incentivized by token grants than they were cash. And they've got a lot of experience in crypto, but we're not necessarily like senior engineers that had been through like multiple cycles of like, technology changes, like no different architectures, like really well. We brought in, I would say like 10 or 15 engineers over the last 6 months that are like just incredible relative to like the baseline of crypto engineers. Now they don't have the crypto knowledge, in fairness, right? Like they're just pure engineers. But they come in and, they're like, hey, there are like some risks here that you guys are taking that like, and there's one guy who just like wanders around. It's like, Tay, you're going to love this, right? It's like, imagine you're building a house, right? And you bring in a guy and the guy's like, so you can't plug the wires into like the load bearing like metal pole there. Someone's going to electrocute themselves. And they're like, I'm just going to unwind this and like plug it into the right, right? Like, and it's just like, and he just walks around all day long, just unpicking like these things where he's like, I see. And this is the biggest difference with senior engineers versus, a junior engineer. Junior engineer sees a mistake or sees like a thing that exists that is not optimal, right? And they get mad about it. They're like, fucking idiots, why did you do this? A senior engineer looks at it and goes, I understand why you thought it was a good idea to like plug this into this thing. I'm not even gonna criticize you. I'm just gonna unplug it quietly and plug it into the right place, and like we'll all move on with our lives. And it just is a completely different mindset.
No, it is. So there's been similar things where I've been like sitting there banging my head against the wall being like, I know there's a better way to do this, but I don't have like the technical expertise to like even figure out what it means. I just know that this can't be the best way. We did it with releases once, and it was like, sat down with a guy who I didn't even know had history doing like release management. And he starts like telling me about like what he does and stuff. And like, no joke, this guy had been basically optimizing the release flows for like huge software projects for like 15 years. And he starts and I was like, I just don't know how we could ever do this and this and this. And he's like, what? That's like the most basic. He's like, no. We should be able to do that like instantly. And then also if there's a thing or if there's an issue or if there's even a potential issue, then you have a whole thing over here that just, and I was sitting there like
back and freezes things. And I know.
And he was like, this is like basic. And I was like, can we do this, please? Like, what is he doing, bro?
It's also like part of the crypto bubble is like, I'm not going to hire the guy with 15 years of like, release management, like DevSecOps, because he doesn't know what Pengu is. And so he's a fucking idiot. And so like, how could I hire that guy? Like he's going to be like, there's a penguin token. I don't like what like, and it doesn't do anything. I'm confused, right? I'm like, get out of my office. Like, I'm not hiring. All right. Well, that was fun. That's it for this episode of Uneasy Money. Thanks for tuning in. If you liked the episode, follow us on the Unchained feed on X/Twitter, YouTube, or wherever you get your podcasts. And we'll see you guys next week.